Good afternoon and welcome to the St. Mary's County Governance 457B Committee, or Governance Committee, excuse me. My name is David Weiskopf and I am the County Administrator. And as always, this is the call to order, and we will start as we always do with introductions on my far left.
Catherine Pratson, Plan Administrator and Director of Human Resources.
Joy Sapp, Acting CFO.
Chris Caslamus, Director of Economic Development for the county.
Dylan Payne, employee member.
Tracy McPherson, Recorder.
Okay, and next we will start with a approval of today's agenda.
I move to approve the agenda.
I second.
I have a first and a second. All those in favor signify by saying aye.
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 Aye. Ayes have it. Motion carries. Next up is the approval of the February 22nd meeting. Are there any additions, corrections, deletions?
Nope. I'll move to approve the February 22nd meeting minutes also.
A second.
I have a first and a second. All those in favor signify by saying aye.
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 Ayes have it. Motion carries. Thank you. Moving right along, new business, the Q1 Voya Plan Summary. Welcome.
It's nice to be here in person.
And I'm sorry, do we have a new member joining soon to replace Ms.
We
Fee?
do. That was going to be an announcement, so.
Oh, I'm sorry. Well, okay. I didn't mean to jump ahead.
No. July 1,
Okay.
Tracy will be the new employee member of the committee.
Oh, and so you are training your replacement behind
Yes.
you. Okay. We are all on board. Sorry.
No problem. And Tracy, do you mind just advancing? Sure. The third slide. Great. I'm going to walk you through an update for the first quarter.
Oh, Mike, are you in the microphone? I think that's what he said. Speaking into the microphone,
Okay, can you hear me now?
I guess.
So if you look at the far right-hand column, you see the beginning of the year, we had $22.2 million in assets. Another $371,000 was added through employee deferrals. The vast majority of those deferrals are being made on a pre-tax basis. And when we annualize that figure, we are on track to exceed the total contributions that were made during 2023. We did have some distributions, which represented 13 participants. One was a death claim, and then recurring withdrawals, and then full withdrawals. Loan activity was positive, and what that means is there were fewer loans taken out during the first quarter compared to the repayments, which is always good news. Other activity is the net of asset transfers, fees, and dividends, and this number was negative, and that was because we had a reversal of an asset transfer, funds that were moved into the plan and then withdrawn. And with the appreciation of about $1.2 million, the balance at the end of the quarter was $23.8 million. Next slide, please. We did add 16 new accounts during the first quarter, which puts us on pace to exceed last year's total number of enrollments. There were 6 participants that took a distribution because they had a qualifying event, leaving a total of 422 participants. And again, as a reminder, that number represents both active employees as well as those that separated from service. There are 124 participants that separated from service but kept their money within the plan, and then 25 of those participants have a balance of less than $5,000. Now, with the legislation that was introduced, this year, the the threshold for small balances is increased from 5,000 to 7,000. So effective July, we have increased that amount from 5,000 to 7,000. And then Catherine is working with our plan manager to implement the force out of those small balances.
And the force out, what it basically does is sends them a letter saying, hey, you need to get out. But if they don't get out after a certain period of time, they just go into a different one of your plans, right? They're not
Correct.
harmed,
So
really.
if it's less than $1,000, we'll automatically send that money to them, and then they can reinvest it, cash it. But otherwise, balances greater than 1,000 will be rolled over into an IRA. And the letter will provide them with all of their options.
Gotcha. And as far as new accounts go, I'd love to know the number after we just did, what do we call it that we do with enrollment, or open enrollment, right?
Oh, yes, yes.
Because this is, obviously a choice under open enrollment, and I'm curious, obviously, we don't have the numbers today, but I'm curious if you would have had a spike from that, right? Because we made, well, not made, but every employee, manually,
Required,
was
right.
required to go in and, make the choices, right? What sort of health insurance I want, life insurance, do I want disability? And obviously, the Voya plan was one of those. So hopefully you got a little spike on that.
Yeah.
Definitely track that, and I can report back.
I was
with
just
enrollment
curious.
numbers.
Yeah, and then one of the things that we've been doing that have been very successful is Marta is going on site to different locations, and she had a day at the sheriff's office that was very successful,
Great.
and is planning one for DPW. So,
Yep, that's another, great.
And then if you look at the chart right below, it just says breakdown of participation by age group. Next slide. The average account balance was $56,478, so it's trending in the right direction, continues to grow. The average deferral percentage remained the same, 8%, but the percentage for new enrollees was 5.3%. For those that elected a percentage, or $89. For those that elected a dollar amount. The average number of holdings remained the same, and then we did see an increase in the utilization of the managed accounts. We had 3 additional accounts, and those individuals that elected this option elected it during the enrollment process.
The managed accounts, is that meaning the ones that pick the actual stocks they want, or?
Right, so the managed account is a separate option where they, for those individuals that want advice,
Oh, gotcha, okay.
and so they have 2 options.
Oh, managed by Voya,
Correct.
I follow.
And more, in partnership with Morningstar, yes.
I follow.
Next slide. This slide just represents a breakdown of the assets as well as the contribution at a higher level. And looking back at the end of last year, I did notice, in comparison with the stability of principal, the assets did decrease, but we did see an increase in the assets under the mutual funds. So, next slide.
Right, and target dates still make up a huge percentage of.
Correct.
Right.
The target date.
That's just select it and forget about it, right, or whatever they.
Absolutely, and that's what we typically see when you default to a target date fund. Most people continue with the target date option. And out of the 422 participants, there were 328 that utilized the one option, and 97% of them are utilizing one of the target date fund options. And we'll move on to engagement. Here, engagement continues to be strong. We did see a 1% increase during the quarter, so 72% of the plan participants are engaging, whether it's through the call center, mobile app, or participant website. And then right below that's just a breakdown by age group, how they're engaging. In addition, the e-delivery and web registration numbers have continued to be strong. We did see an increase in web registration. It jumped from 68% from the end of 2023 to 70%. So we had 12 more participants that registered their account. And as you've heard me say in the past, Engagement does have a impact on retirement options or income replacement. And this slide just shows you income replacement ratios based on how participants are engaging. So on average, participants are on target to replace about 46% of their income during retirement. And then we have 21% of the participants are on track to replace 70% of their income. Our goal is to have participants replace at least 70% of their income during retirement. This slide just shows you the number of participants that have engaged by resource and the type of action that they took. And the majority of the action that was taken related to deferral changes. Next slide. And we had 8 participants that utilized the My Orange Money tool. And as a result, 3 participants took action. So that was about 37.5% of the participants took action, resulting in increasing their deferral amount, which is positive. And then I'll wrap up with engagement with MARTA. The overall engagement is on track to exceed last year's numbers. And I think the partnership that Catherine mentioned earlier, our partnership with Catherine's team, has really helped in driving the overall engagement. Cindy has been contacting various departments to schedule on-site visits. As Catherine mentioned, MARTA was on site with the Sheriff's Office recently. She had 6 appointments, which resulted in 2 enrollments and 1 rollover into the plan. And so we appreciate that partnership with you and your team, Catherine. But overall, looking at the plan and what we're hearing from participants, everything's going smoothly from our perspective. Any questions?
Is there, I mean, this is not really an investment question, but is there like a rule of thumb? Like you had mentioned earlier that people are averaging putting 8% of their salary, electing to put 8% of their salary into the 457. And I know through our state retirement, we put in 7%, right, towards our, defined pension that way. So in a way, that's 15%, I guess. But is there like a rule of thumb that you should be saving X percent of your?
The general rule of thumb is about 10% of your income in these plans, but it does depend
10%, and I'm sorry, 10% into the Voya plan in addition to the?
into the supplemental plan. Because the
gotcha.
goal is to replace at least 70% of your income, so you have your Social Security and your pension, and then your supplemental savings.
Gotcha.
And it can vary for each individual, but generally, we use 10%.
I gotcha. Okay. Any other questions? Great presentation, as always. We appreciate it.
And perhaps a motion?
Oh, to accept, yes, thank you.
I move to approve the 457B 2024 Quarter 1 Voya Plan Summary.
I second.
I have a first and a second. All those in favor signify by saying aye. Aye. Ayes have it. Motion carries. Thank you very much. Now we have Mr. Wing with Marquette Associates to give us the investment performance report. Welcome.
Thank you, Mr. Weiskopf, and good afternoon, everyone. Nice to see you all again. So we have the Q1 report. If you would all grab Exhibit 2, flip that over and jump to page 13 if you could. We'll start with a quick overview of markets more broadly, and then we'll get a little bit more granular. Just provide a little bit of context for how and why some of the investment options performed the way they did during the quarter.
I think you've got the wrong one.
Yeah.
We need the Marquette one.
That one looked a little sharper. So.
No worries.
Yeah. There we go. Great. And we can go to page 13, please. So on page 13, again, just quickly from a pretty high level from an asset class perspective. There we go, a few more. There we go. So just from an asset class perspective, I'll start with equity markets. You can see in the top 3 rows there, pretty strong quarters, particularly for U.S. equities. You could see up around double digits for the quarter. The Q1 numbers are in green up and down across that chart, followed by international developed equities at just a shade under 6%, and then emerging at about 2.5%. When these returns were actually remarkably similar to what we saw in Q4. So again, another particularly strong quarter for U.S. equities. Now, on the flip side, if you go to the 4th row down, you'll see bonds, their investment grade bonds, were actually in the red, slightly down, just under 1%. And really what drove the underperformance of fixed income was a little bit worse than expected inflation data in Q1, put some upward pressure on interest rates, which put downward pressure on bond prices. So the two there, rates and bond prices, move in opposite directions. So that's why bonds were under a little bit of pressure in Q1. You'll see the 2 rows below that where you see bank loans and high yield bonds. Those are 2 types of sub-investment grade debt or below investment grade debt. They're a little riskier than investment grade bonds, but you could see in contrast, they were actually positive during the quarter. And that's what you would expect in an environment where equities, like I showed with US, were up almost 10%. And I mention all that because the 2 active fixed income managers in the plan, or 2 active options, excuse me, they're both PIMCO funds, one in the US and one in international, both outperformed. Typically active managers, including PIMCO, will have a little bit more money invested in corporate bonds and a small slice in sub-investment grade debt, be overweight those areas, and underweight safer treasury bonds. So the outperformance of riskier fixed income during the quarter proved to be a tailwind for those 2 options relative to their respective benchmarks. The other thing I'll mention on this page, you can see about 4th up from the bottom there, TIPS, or Treasury Inflation Protected Securities, were more or less flat during the quarter. So they did outperform their investment grade counterparts, given that worse than expected inflation data helped TIPS outperform during the quarter, increasing inflation expectations. So again, from a fixed income perspective, the active managers did quite well, and the TIPS dedicated allocation outperformed investment grade bonds. If you go to page 14, just a couple of quick comments I think will be helpful before we review the performance of the plan options here shortly. Just digging underneath the hood of the U.S. equity market for a second, from a sector perspective, which we talk about in the top left bullet point, and you can see some data in the top right. The lighter bars in that top right chart are the Q1 numbers, and you'll note that if you look at the vertical axis there, there's only one number to the left of that vertical axis, meaning only one sector was in the red in Q1, and that was REITs, which have largely traded off whatever rates are doing. There's a lot of commercial real estate debt coming due this year and next year, and to the extent that rates rise, that'll make it the refinancing of some of that debt a little bit harder for commercial property. So that, coupled with some of the structural headwinds, particularly in the office sector, had REITs in the red for Q1. You know, another interesting dynamic, if we look at the second bullet point to the left, where it notes from a style perspective, growth stocks top value stocks once again. So that's a dynamic that's been in place largely for the past 15 months or so, or maybe even year and a half, where really a handful of very large information technology, AI-related names have really driven the bulk of the gains in the market. You may have heard the NOMR, the Magnificent Seven, really largest stocks in the market, the Apples, Microsofts, NVIDIA, so on and so forth. But what was interesting is that there was some dispersion within those names. So all 7 didn't do well. 2 notably did quite poorly, namely Apple, which was down around 11%, and Tesla, which was down around 30% during the quarter. So it really was a big driver for manager performance, you know, in the large cap growth space, you know, your relative weightings to those 7 stocks, and particularly the 2 that did poorly. So as we'll see here shortly, the large cap growth manager Fidelity actually did quite well, given they were underweight those 2 names that underperformed quite dramatically. The other thing I wanted to note, really around the bottom chart to the right there on page 14 still, here we're showing relative returns. So you can see in the header to that chart, Q1 returns relative to the Russell 1000. And in the legend on the bottom, as you work your way from left to right, starting with momentum and ending with yield, you think of that as an investment style, or it's sometimes called a factor. So things like I spoke to earlier, when you get the value growth in the middle of the page, you can see that value bar beneath or under zero, meaning it underperformed, and vice versa for growth. But what's interesting as you work your way further to the right there, where you see size quite dramatically underneath zero, meaning that smaller companies did worse than the broad market. And probably the most pertinent is the one all the way to the right, yield. So think about that as, higher yielding stocks, dividend paying stocks, more income related strategies did quite poorly during the quarter, at least on a relative basis, because those types of stocks were under pressure from a relative perspective in Q1. So as we look to the returns of the plan options here shortly, the large cap value manager, JP Morgan, follows more of a yield type strategy. So given those stocks underperformed during the quarter, that was a pretty big headwind for them on a relative basis. So with that said, if you want to grab Exhibit 3, we'll get into some of the plan metrics starting on page 22 from a qualitative perspective, and then we'll jump in to some of the data, and I'll try not to repeat Sarla's comments too much throughout my remarks. But as she noted earlier, you can see the plan assets up top were shade under 24 million. Per your question, Mr. Weiskopf, underneath there, you can see the target date funds comprised about 73% of the plan assets. We call that, kind of a do it for me per your comment, right? Or set it and forget it, where participants are just allocating to those funds and kind of, going about their business and letting those funds manage their exposures over time. As far as the individual options, you'll note that under active equity manager performance, most outperform their respective benchmarks. Within fixed income, as I mentioned, both PIMCO funds beat their benchmark. So from an equity and fixed income perspective, it was a pretty strong quarter from a relative return perspective. And then the target date funds, as we note, their performance was strong across the series in Q1, and longer term results remain strong across the series. And we'll get into greater detail of that here shortly, as Mr. David Saunders is in the crowd today, and we'll give the committee a broader update along with his colleague on the target date series. As far as looking ahead, the fund additions that the committee approved at the last meeting were added to the plan as options. Again, we have the American Funds presentation, and what I'd like to begin to tackle as we work through the rest of the calendar year is, more of a lineup fever do. When we talked about things from a fiduciary perspective, obviously monitoring fees is of utmost importance from a participant perspective. So I think a helpful exercise might be to take a look at, the current fees of the existing options within the plan and kind of comparing them to the median and average fee of the options within each of those respective asset classes within the Voya lineup. So again, it's not something that we've tackled yet. We've done a lot, right? The investment policy is in place. We had a couple of fund additions. So now I think some due diligence on the options themselves is certainly warranted. If you look at page 23, just quickly, not a page we usually hit on, but you can see towards the right there, the plan is at a high watermark as far as the assets themselves, and Sarla spoke to this a little bit. A lot of the gains from the previous quarter were driven not just by net cash flow into the plan itself, but also obviously investment gains from the individual options per my comments around the market environment. If you go to 24 quickly, just a breakdown of the plan assets, and I won't focus on the individual lineups, but more from an asset class perspective. So if you look all the way to the right and specifically focus on those gray bars, you'll note that the second gray bar there at 17.8%. So that's what's allocated to the individual U.S. equity funds. That ticked up almost a percentage point and a half from Q4. Again, not surprising given my comments that U.S. equities were up 10%, really the best performing asset class. So you would expect an increase in an allocation there from a percentage perspective. As you work your way down the page, again, just focusing on those gray rows, non-U.S. equities didn't really change that much from the previous quarter, not surprising given the fact that it only comprises about a little more than 1% of the fund. Where we did see a decent change was within fixed income, now comprising about 8% of plan assets, down from 8.7. And again, not surprising given the performance I discussed a few minutes ago, where fixed income was one of the only major asset classes that posted a negative return in Q1. And then finally, per my comments earlier, you can see the target date funds comprise about 73% of the plan assets, largely unchanged. But if you work your way to the column to the left, you can see from a dollar perspective, we're talking about $17.34 million. So again, the vast majority of the assets in those target date funds. On the next page, quickly, we typically don't hit this page, but every once in a while, I think it's worth pointing out that this is a manager status page. So basically think of this around our ongoing due diligence of the investment options within the plan. So if you look to the left, you can see all the managers listed, the respective asset classes in the second column, and then status in that third column where they're all in compliance, which really just means that Marquette doesn't have any immediate concerns around any of these options. If we did, you would see a status meaning on alert, which is essentially our nomenclature for watch list, and then a reason to the right. But from right now, our manager research team doesn't have any concerns around any of the investment options within the plan. Now, if we jump to page 26, I just want to walk through some of the performance of the underlying options. As I talked earlier, they were broadly positive, absent a couple of names here, which I'll dig into. But we start on 26 as far as the U.S. equity managers. As I talked about earlier, the first one there, JP Morgan Equity Income. You could see the Q1 return under 3 months was up 7.3%, but about 1.5 percentage points or so beneath the benchmark. So per my comments earlier, again, equity income is a strategy that focuses on stocks with a higher yield paying dividends. And per the chart we spoke to earlier, those stocks were under quite a bit of pressure, at least on a relative basis. So one of the reasons we talk about the market environment is you can't really look at these returns in a vacuum, right? If everybody has a distinct investment process and strategy, and it may or may not have been in favor depending on the broader market environment. So they focus on higher yielding stocks. Those stocks did not do well on a relative basis, so it's not a surprise to see them be behind their respective benchmark. You go down a couple of gray rows, you see the Fidelity Contra Fund there, the large cap growth options. Per my comments earlier, you can see it was up almost 18% during the quarter, more than 6 percentage points ahead of the benchmark. And again, a lot of that outperformance, and really for many of the managers in that space, really was determined by your relative weightings to those largest stocks. So this fund, again, has a decent underweight to Apple and Tesla, which did not do well. So Apple was down around 11%, Tesla was down around 30%, whereas the benchmark was up 11.4%. So even if you had just a mild underweight to Tesla, that was 40 percentage points behind the benchmark, which would have been a huge tailwind on a relative basis. And Fidelity was underweight both those stocks, so that was very helpful for them during the quarter. A couple things I want to mention as it relates to Allspring, and I'll kind of talk about them in conjunction. They're in the mid-cap value space as well as the small-cap value space, doing well in both mid-cap and particularly in small-cap. And what's interesting is we talked a little bit about this in past meetings, but as far as corporations, a lot of corporations took advantage of the low interest rate environment a couple years ago to issue debt or refinance debt at low rates, but those are usually larger corporations. More mid-size and smaller corporations typically issue more short-term debt or even floating rate debt, meaning that as rates have risen more recently, they've come under more pressure from an earnings and cash flow perspective, as you have to pay more interest on debt that's either floating rate or debt that you've had to refinance at higher rates. And I mention all that because Allspring has a pretty unique investment process where many investment managers have a keen focus on the income statement, so cash flow, earnings, expenses, et cetera, where Allspring focuses somewhat on that, but a lot on the balance sheet. So where rates come into play, so leverage, interest coverage ratios, things of that nature. So that part of their focus has almost been somewhat tailor-made for this environment, where a lot of small and mid-sized stocks are suffering some balance sheet pressure given those higher rates. So given a lot of their focus has been on that side of the equation, you could see in Q1, whether it be the mid-cap value space where they outperformed by a percentage point, but also notably in the small-cap value space. So that would be the third gray row up from the bottom. They were notably ahead of the benchmark, and we think that was largely due to, again, their focus on a lot of those balance sheet metrics. One other note, if you look at the last gray row on the page, the Wasatch Core Growth Fund, you can see they were about 3 percentage points behind the benchmark. Within the small cap growth space, there was almost a similar dynamic that was playing out in larger companies, meaning that, you know, the biggest names in that benchmark were doing the best, and there was 2 names in this space that really had almost exponential performance in Q1. A company by the name of Super Micro Computer, which makes servers that a lot of companies are buying to incorporate artificial intelligence, and another company called MicroStrategy, which is a sort of a crypto-related name. So these two are you know, kind of speculative names, and names that Wasatch is not going to hold. They're more of a higher quality, stable businesses, you know, more of a certain type of strategy. And if you didn't own those 2 names, that would have been a 4 percentage point headwind for the manager relative to the benchmark. So they were about 3 behind. So I'd actually argue, you know, being only 3 behind and not owning those 2 names was actually a decent quarter for them. Now, those 2 names, interestingly, will roll out of that benchmark after this Friday when the Russell indices reconstitute themselves. Actually, one of them, Super Micro Computer, is already in the S&P 500. Was put into there a couple months ago, but they'll be out of that benchmark, and the distorted nature will be somewhat alleviated as those 2 names have become such a large portion of those benchmark. But at least for Q1, and admittedly somewhat here in Q2, they've done exceptionally well, and it's going to be a headwind for a manager that focuses more on higher quality type of businesses, you know, more established and certain revenue streams. On 27, just a couple other quick comments before I pause here. You can see in the non-U.S. equity space, the loan option, at least as of March. Again, they're the 2 new options that have been added more recently. But American funds, the Euro-Pacific Growth Fund, performed nicely during the quarter, about 1.5 percentage points ahead of the benchmark. And then within fixed income, as I spoke to earlier, you see both the PIMCO Total Return Fund there and the PIMCO International Bond Fund between 50 and 70 basis points ahead of their respective benchmarks, again, due to the reasons I outlined earlier, you know, having less in safer, say, treasury bonds, which underperformed, and more in corporate bonds, and even a small slice in high yield bonds for the PIMCO Total Return Fund. So all in all, a pretty strong quarter up and down the board for equity and fixed income. Also for the target date funds, I will not go through them. I don't want to scoop Mr. Saunders here and his colleagues who will speak to that. But with all that said, that pretty much wraps up my remarks, and as always, happy to answer any questions or address any comments.
I'm good at the moment. Anybody have any questions?
No, not for me.
Okay, if not, we can thank you for your part.
And we need a motion.
Oh, and a motion. Thank you.
I'll move to approve the 457B 2024 first quarter investment performance as report as presented by Marquette Associates.
I'll second.
I have a first and a second. All those in favor signify by saying aye.
Aye.
Aye. Ayes have it. Motion carries. Next up is the American Funds update. Welcome, sir.
I have,
Oh, that would be great. Sure.
It's so nice to see you. How are you doing? Good, thank you. And I don't know if you have your colleague on Zoom.
he's, I'm going to be logging in, sitting on a Teams, so I have to log in.
Perfect, okay. Maybe just to help with our opening those up.
Okay.
Thank you.
Oh, back when it was, did I just get 2? I did.
I did too.
Here you go.
Help lighten my load back home, so.
Who did David used to be with?
Yeah,
Asset Strategies. Okay.
I'm a recovering consultant, and it's good to be back here. It's good to see everyone. Shall I go ahead and, my colleague, Rich Lang, should be joining us via Zoom. And I'm going to start on page 5 of the presentation. And so, I'll just start out with the pleasantries of thanking the committee, also Pat and the Marquette team with giving us the opportunity to present, but also more importantly, making us a part of your defined contribution lineup. We don't take that lightly, and we're here as a resource, and we work very closely with your consultant. So at any point in time you need anything further from us, just let Pat know, and we're here for that. So on page 5, a little bit about Capital Group that you may or may not know. We've been around for a while. We're over 90 years old. We're going to be celebrating our 100th anniversary here in about 7 years, so we're preparing for that. And I say that all just to say that we've managed money through many market environments. We have $2.7 trillion in assets under management as a firm. We've built that over that time frame. We continue to be privately held. We wear that as a badge of honor because we believe that we are able to invest and do the right thing for our clients while public companies may have to worry about quarterly earnings and satisfying shareholders, sometimes to the detriment of investing in their business. Our Target Date series is part of our multi-asset strategies, of which we have $800 billion. Our portfolio managers have been around for a very long time. Rich will cover that. But the other thing that we're very proud of in the bottom half of the page is that our mutual funds are among the top 10 most used mutual funds in the defined contribution industry. And you can see there, our funds history goes back to 1953. And so we take pride in that. We know how difficult it is to invest in varying market environments. And we certainly are happy that you've chose to work with us. I think we have about 25 minutes to present. I'm going to hand things over to my colleague, Rich. Is he plugged in? He's not. Let me make sure. And I apologize. Rich is in Los Angeles, and he was not able to be here with us. He's mentioned that he was dialed in. Is there a dial-in number?
There should be a dial-in number on the invitation.
It's an interesting time to start the company, right, during the middle of the Depression.
Yeah, well, a lot of great things are, are born out of hope and,
Right.
Amongst the burn of, the environment that's around you. Let's see, I apologize.
Well, you've got 27 years of investment industry experience, so take it away.
Yeah, well, as we go through if we go to page 10, this page shows our, Target Date Committee. This committee, puts the objectives into play, and as you can see, have a very long investment track record. Most of that has been with capital, as you can see in the blue. Michelle Black is our principal investment officer, and she makes sure that policies and objectives are maintained along the glide path along with her team. The team is made up of professionals across fixed income, multi-asset, equity, asset classes. We did have an addition to the team, Samir Mathur. Samir joined the team here this year, bringing more experience from a multi-asset standpoint, and also Shannon Ward, a fixed income professional in high yield, joined the team as well, along with Jessica Spillay. This team, as I mentioned, executes the multi-asset strategy across our glide path. If we go to page 11, page 11 gives you a feel of how we build and preserve wealth across the glide path. As you can imagine, if you're 45 years out from retirement, you're recently hired, your allocation is more heavily weighted towards equity, and so that growth in income is a major part of the asset allocation at the early stages of the career. And as you approach retirement, you'll see that mix start to change, and that growth allocation becomes a smaller piece, and you begin to see more diversification in that preservation allocation. And that's where we get more of a balanced allocation. We're getting more income, inflation protection, and our equity, the types of equity that we're investing in changes as well. And so we're going from more growth-oriented stocks like Apple, NVIDIA, some of the names that Pat spoke of, to more dividend generating equities. And this is more as a, our glide path goes through retirement as opposed to retirement. So it is our expectation that someone at retirement age will still need to have, this money for the next 30 years at least. And so having some exposure to equity is important, but we believe that the equity income component provides some downside protection during volatile moments, and that's where those allocations come in.
Hey, David, this is Rich.
All right, Rich.
Sorry, I just didn't want to interrupt. But,
No, please. I'll hand it over to you. But please pick up. I was on 12, and from a time standpoint, we probably have about 15 minutes.
Okay, great, and thanks. Sorry, I think I had the wrong platform, but thanks, Tracy, for sending me the Zoom link. And yeah, I think what David is covering really is probably our biggest differentiator there on that slide, and the fact that we changed the types of equities. So all target date providers reduce equity for older participants, and we're really the only provider that reduces the volatility of our equity. So, the objective of our series is to balance the build and preserve wealth needs of participants. So we can do this by changing those types of equities. And if you go to page 12, the next slide, you can see that if you look at the top 10 equities in our 2055 vintage. So for a 25, 30-year-old, as David mentioned, you see some of those Magnificent Seven more growth-oriented stocks, but for a 70-year-old in the 2020 vintage, you see a much different portfolio. And this seems intuitive, I would say, when I go out and talk to other advisors, wealth managers. If a 65-year-old were to come to them and say, hey, I need a distribution-type portfolio to support income in retirement, you're not going to put the Magnificent Seven in their top 10 equities. And that's, for the large part, what the industry does. They don't distinguish the types of equities for a 25 and a 70-year-old. They have the same equity holdings. So this is how we're able to have more equity than the average target date series, but with a lower volatility profiles, because we take another lever to reducing volatility, reducing equity, and then reducing the volatility of the equity. Maybe if we go to slide 14, you can see the underlying holdings that we use at various points in the glide path. So here you can see the different strategies. They're listed by their volatility within the objective categories. So you'll notice within the growth category, the more volatile funds we phase out of sooner the Small Cap World Fund, New World Funds, our Emerging Market Global Fund. You'll also notice allocations to global equity strategies. Small Cap World Fund is a global small cap fund. New Perspective in the growth category, you see a 10% allocation. That's also a global fund. So another differentiator of our series is we'll use those types of global equity funds. Our equity income and balanced funds there in the middle of the page have both stocks and bonds. We feel our strength of capital is active management, and it's not making top-down allocation decisions. Most providers in the industry will be more regional pure, asset class pure in their underlying strategy allocations. And this approach has really benefited participants. If you look on, maybe go to page 17, you can see the flex of the series. So given these underlying strategies that can invest U.S., non-U.S., the allocations will change based on the opportunities in the market where those managers and those strategies are investing. So in the upper right-hand corner, you can see the geographic flexibility, the non-U.S. equity exposure as percentage of equity. And over the lifetime of the series is represented by the gray shaded area. It's been about 1,000 basis points. So further from retirement, you can see we're kind of currently at that lower end allocation, closer to 30%. There's been points in time we've been as high as 40%. The last 12 years or so, we have been at the lower end of that allocation because our managers in those strategies have found U.S. markets, companies more attractive. And as you probably know, U.S. markets have outpaced non-U.S. over that time period by about 8% annualized. So that's another way we've been able to add value for participants is by this bottom-up flexibility. There have been points in time where we have more non-U.S. than peers. Our competitors will like to say the reason we're doing well is because we have a structural bias to U.S. equities, and that's definitely not the case. It's definitely been the tilt over the last 12 years. And as I mentioned, there's been points in time we've had more non-U.S. And then if you look in the bottom left, you can see that growth style flexibility. So as defined by Morningstar, you can see that downward sloping growth style allocation. Pretty meaningful flexibility there, about 1,500, almost 2,000 basis points across the glide path. But strategically, we're going to have more growth exposure for peers than peers for younger participants. As you get closer to retirement, moving more to dividend-focused equities, historically, that's kind of more in the value category. So we'll always have that downward sloping allocation, which is really the differentiator of the industry. Is kind of just a straight line across. Their average growth allocations around 37%, and it's the same for all investors. So I would say that's a key differentiator as well. Maybe go to results real quick. To page 24, David, if you can. So we talk about the importance of balancing the objectives of building and preserving wealth. So this slide illustrates when equity markets trade off in heat map form and in rankings, how is the series held up? So the more green, the better. The lower the ranks, the better. You can see on the far left, the global financial crisis period. We've had some corrections where the S&P's been down at least 10%. And then you can see the bear market period of 2022 where growth sold off quite considerably. You also had yields increase. Fixed income was positively correlated. Both fixed income and equities were down in 2022. But what you'll notice is those near retirement vintages in that bear market period, generally top quartile, top decile of peers. So even though we have more equity, for those near retirement participants, they held up well and provided that resilience because the dividend paying area of the market held up much better than the more growth oriented. And then you can see on average in the far right across all time periods, vintages, when equities sell off, our series broadly top quartile, top quintile of peers. So that strategic approach, our active management also helps mitigate some of that volatility. Every one of our equity strategies has a downside capture ratio against its index over its lifetime of below 100. So we're able to generate better returns when markets sell off on a relative basis than a passively implemented option. And then if you look at the next slide, we talk about the balance. It's not just about preservation. Here we look at the 10-year upside capture ratio against the Morningstar peer average and the 10-year downside. Obviously, you want to capture more on the upside than the peer average, and every vintage has done that. And then you want to preserve better on the downside with the downside below 100, and you can see every vintage has done that. And in fact, we're the only provider in the industry with this profile. Every vintage above 100 on the upside and below 100 on the downside. So I feel it's a good proof point or an illustration that we've been able to deliver on that objective of balancing the building and preserving of wealth. And then the next slide shows the actual rankings of the series as of March 31st, 2024. And you can see the 3, 5, and 10-year. Generally, as the time periods get longer, you see over a full market cycle, those 10-year ranks, many of them first percentile. Our series goes back to 2007, and actually there's been 86 rolling 10-year periods. Over half the time, we've been fortunate enough to generate industry-leading returns in our series. And if you look at the standard deviation ranks, the lower the ranks, the better. You can see, every one below 50th percentile, most below 33rd percentile. So generating those strong returns with kind of that conservative to moderate risk profile, you get those Sharpe ratio ranks. So Sharpe ratios are a risk-adjusted metric. How much return are you providing per unit of standard deviation or volatility? And once again, you see first percentile, and over 3/4 of those rolling 10-year periods, we've been able to generate industry-leading risk-adjusted results. So, we continue to be thoughtful about how we implement our target date series. That active management and that strategic design has been able to consistently deliver that profile of returns and results. So I'll stop there, see if we have any questions.
Doesn't look like we have any questions in the room. I know that we've had a full agenda here, Rich. So again, we leave it open for any questions that you might have, any follow-ups that you might need from us. We're happy to do so.
This is David Weiskopf, Rich. I don't think you're seeing us. I think you're just hearing us. Mike.
I can see you.
Oh, okay. We just.
How's it going?
Okay, good. Good. Thanks. Mike. Oh, there you are. Okay, you weren't on our screen. Well, hello. My question is, what happens when one of our employees or just anybody in general says, okay, I didn't start until I'm 35, or I didn't start looking at this until I'm 40. Are these still good plans to do? Because I note what you're showing us starts at age 20 when you're gathering accumulating the wealth, right? Which are probably so if I'm 40. Just started, I probably need to do something riskier to try to accumulate, right? I'm just curious.
Yeah, no, I mean, that's the $1 million question is what do you do if you've started saving too late? Target
never
date
say
funds
too late,
aren't
but
gonna be able to alleviate a saving issue. Right. And the argument is you could be more aggressive, and they could decide to, choose a more conservative or a more aggressive vintage that wouldn't align to their, age 65. So they could go in the 2055, 2060.
I got you. Pretend, vintage. Even though they're 40, pretend that they're really 20 or 30, and I follow you.
Mm-hmm. Yeah, and they could try to make it up that way, but, the other argument is, what? There's a shortfall there. They need to preserve what they have.
Right, right.
Do you just go into their appropriate, we'll say 2035 vintage, or 20, whatever vintage that might be, and then just try to make up for it.
And maybe they have to put more into it.
Yeah, or maybe they have to work longer. I mean, this doesn't include Social Security and other benefits.
Right.
That
It was just a curiosity question.
Yeah.
Good,
but no,
good
these are I know. Well, as you can tell, what is it? 70% of our people are in these.
Yeah, about 72%. I believe I saw Pat's presentation, which is about average that we see across. It's a as was brought up before, it's a less stressful way to retire and not think about when do I need to change things and what allocations we need to have. So yes.
Yeah, I'm in the investment industry. Obviously, I'm 100% in our target date fund. So I used to allocate on my own into our investment, our retirement plan. After a few years, I realized I was trailing the results of our target date series. So just let the professionals take care of it.
I understand. Yeah, I don't get riskier than what are the index fund, type things.
Well, in our we have the investor series for the fees, so our funds are fabulous.
Right. Fee-wise,
Right.
you can't beat it, right? That's
Right.
Yeah, we continue to be the lowest cost, actively managed target date mutual fund series in the industry. So fees are incredibly important. Obviously, we're an active manager. Our fees are a bit higher than index or passive, but we've been able to generate net of fee returns well beyond the fees we charge.
Yeah.
right. Yeah, all great stuff.
Well, thank everyone. Rich, thanks for joining in. Sorry for the delay. Hope I filled in at least part of the way for you, Rich. So thanks for picking up.
I wanted to listen to the rest of the way. I thought I should jump in.
You see me sweat. Perfect.
Yeah,
Thank
all-
you so
All right,
much.
thanks, everyone.
Thank
Thank
you.
you. Take care. Yep. That's right. We didn't notice that he had 3 more years than you, right? We couldn't even tell. Okay, but thank you very much for that. I think, today's been great, right? Everybody's, seems that it was a great switch to Voya. It was great that we got Pat. I mean, sometimes I see too much of them with all these, between the sheriff's office and 457 and LoSAP and OPEB, but it's great, right? There's something to be said for, being a part of it all. Do we need American Funds update was just simply an update. I don't need a motion for that, right? And we would,
I don't recall if it's in
No
the.
motion.
there's no motion, so
Okay.
we would roll right into the 457 old business, which is the 457B new plan investment options update.
Yes, and I think Pat mentioned this already, but at the last meeting, the board approved adding 3 additional funds to the plan.
Oh, right, that was that thing about like
Yep, the style
growth
boxes.
versus, right.
Yep, and that has occurred. Any of you who participate would have gotten a letter in the mail, and the funds were added, I think it was the 20th of June. So, and then I think Sarla mentioned that you also voted to have a mandatory withdrawal of funds, of small funds for terminated participants, and I am working on that process with our plan manager.
Now, we voted on that when we believed it was 5,000, right? And it's since moved to 7. Do we have to vote on that again then? Or is it just because it's still considered a small participant? Whether it's 5 or 7 doesn't matter?
I think that we knew that it was going to move
Oh,
to
okay,
7
okay.
in July 1, and
Okay.
so we incorporated that.
Okay, perfect.
But thank you.
Apologies for not remembering.
No, it's all good. Thank you.
And that would take us to the administrator's report.
And we had no expense payments since the last meeting.
Well, great. Well, that means I will look for one final motion.
And if I could just add, and I think we
absolutely.
already spoke, that
Yes.
Tracy is the new employee member for the committee, so thank you, Tracy, and
She
look
will
forward to having you.
sit up here next
Yes,
time.
yep,
Great.
and Jennifer will be the new recorder for the plan, so thank you for coming.
Great. And then Jennifer, in a couple of years, we'll see you up here. And Tracy will be enjoying her 30-year retirement according to American Funds, right? That's awesome. May we all get that, right?
All right, may we all get that. And then our next meeting is September 26th.
Great. Does anybody have anything for the good of the cause, as they say? If not, I will entertain a motion.
I move to adjourn the 457B Governance Committee meeting.
I second.
I have a first and a second. All in favor signify by saying aye.
Aye.
Aye. Ayes have it. Motion carries. Thank you.
Thank you,
everyone.
everybody.
And Mr. Wing, we will see you.